This is Planning for Long-Term Care, the podcast, with Key Planning Partners.
Welcome to the show. We're sitting here with Tom Visello and Marie Colbert from Key Planning Partners, and we're going to talk today about planning for the future and different ways for you to plan when it comes to extended care. So, Tom, what are the different ways you can fund your planning?
Well, there's a number of different ways to fund long-term care. You want to look at the different tax advantages that you may have. Some people may have old annuities that they purchased years ago. They have a lot of gain in it, and every dollar they take out is going to be fully taxable to them. But thanks to the Pension Protection Act, there's changes that can be made to that annuity so that those funds come out tax-free if you need it for long-term care.
What is the Pension Protection Act?
There was a law that was passed several years ago that basically encourages people to plan for long-term care. The government saw that there was an unfunded liability coming forward regarding all the baby boomers turning 65 and the amount of long-term care. And it just carved out some real tax advantages for people that want to pre-plan for long-term care. What
are some of the main tax advantages you can take advantage of?
Well, there's several. There's some with Pension Protection Act, which would allow you to take this annuity that if you just withdrew the money, it would all be taxable income to you, which could affect the amount of your Social Security that's taxable. It can affect your Medicare premiums. But if you need it for long-term care, it'll come out tax-free. It'd be a lot like a healthcare savings account, but specifically for long-term care. And it's really the only way you'd be able to access those funds tax-free.
Also, a lot of people think of long-term care and think that they hear single premium, or there's a lot of different ways that these new products will allow you to fund, whether it's a single pay or a 10 pay, 20 pay, or even a lifetime pay. So there's options there as well.
When you're saying the 10 pay, 20 pay, what does that mean in particular?
So that means that you're going to pay for 10 years, an annual premium, years 1 through 10, and then you're done. 20 pay would be the same after the 20th year, you're done. And we would look at, based on your individual situation, which one may be more advantageous than the other, and even compare it against a single pay as well as a lifetime pay.
Because everybody's unique, right?
Exactly.
Everybody's got different situations.
And Tom, that may be
there's never a one-size-fits-all approach when it comes to long-term care. We need to take a look at what your situation is, what type of assets you own. Do you have IRAs or 401ks, qualified money? Do you have non-qualified annuities? Do you have old life insurance policies that you don't need anymore? We can take those assets and leverage them for long-term care in tax advantage ways. And we're getting a little stuck on the financial side of it. People need to put together a plan for long-term care as well and talk to advisors regarding it. I've been specializing in long-term care for 29 years now. And one of the things I see when people are planning in crisis, maybe they're helping their parents out who have dementia right now, they don't really know what their parents' desires were when they were still their parents. And many times those children feel almost guilty, and we don't want mom to go in an assisted living facility or dad to go into an assisted living facility. We'd rather have them move in with us, which would be an extreme burden on the children. And when their parents were still their parents, I'd be willing to bet they didn't want that. They did not want to become a burden on their children. So you want to make sure you have a plan that can be communicated to your children, even if it's to the point where you can't speak for yourself.
Sometimes it can be an uncomfortable conversation, but it's one we all really need to have.
Well, you don't even have to have the conversation because we have tools that can allow you to put together the plan, and your kids you don't have to have the conversation with your kids until you actually need it. But now all of a sudden when you need it and there's a plan there designed, the kids can follow that plan and have a lot more comfort knowing that they're doing what you wanted them to do.
And also to add to that is a lot of times with the plan, before with the traditional long-term care policies that I'm sure many people have seen their parents may have had, they paid all of this premium into it, and if they didn't use it, they didn't get any benefit. Well, in this situation, they're planning for the future. They're paying these long-term care premiums, but if they don't use it, there's a tax-free death benefit to their beneficiaries. So it's not something that you're going to pay for and never get any benefit.
And one of the things that I always hear when we talk about this is a huge benefit is the peace of mind for the person that's planning. There's if you've got kids, if you've got a family, things like that, there's times that you're kept up at night wondering, like, how am I going to do this? How's this going to happen? and it becomes a bigger burden as you move on. Like, oh my gosh, I don't have a will, I don't have this. It's the peace of mind with the planning that really helps. I mean, that's what you're buying.
You're buying peace of mind. You're also buying leverage. You're setting it up so $1 can do the work of $4 or $5. So you're protecting something for your kids. The other thing that you're buying, I saw a recent statistic, as soon as a parent moves in with a child, on average, it's going to cost that child $655,000. And that's because they're reducing their hours at work, they're passing up promotions, maybe they're retiring early. That means that they aren't contributing as much to Social Security, their pension plans, their 401ks. And over their life, it's going to cost that child $655,000. And if parents really know that, they don't want to become a burden on their children. They want to put together a plan ahead of time. It's just if you wait too long, you get to the point where you may not be in your right mind. You may not be thinking as clearly as you are today. And then your kids have to guess what you want. And your kids are your kids. They're going to be there for you. They're going to do what's needed. But you may not want to put your children in that situation.
And speaking on that note about waiting too long, I think some people have the misconception that maybe a certain health impairment may preclude them from qualifying for long-term care insurance or for that leverage that Tom is talking about. But I'll let Tom kind of expand a little bit more on, the different options that we do have, whether you're young and healthy or you're already in a nursing home.
Yeah, all planning is about creating leverage. It's about using $1 to do the work of $4 or $5. And it was Archimedes that said, give me a lever long enough and a fulcrum strong enough and I can move the world. And it's true. If you're young and healthy, there's a lot of leverage we can create for long-term care. But even if you're currently in a nursing home or currently in an assisted living facility or receiving home health care, there's still plans that can be put together. We can't create as much leverage as we can for the young, healthy person, but there's plans that can be put together to make sure that care is sustainable.
Right. So when I'm putting together my plan, what are some concerns that I should have?
Well, one thing we want to understand is where would you want to receive care? Not only the type of care, and most people want to stay in their own home as long as possible, and then where would they go after they were done after they could no longer receive care in their own home? But what part of the country would you want to receive care in? The state of Connecticut, it's much more expensive to receive care than it is in Florida, for example. So if you want to go back up to Connecticut to receive care, it's going to require more resources than it would be in Florida. The other thing you want to understand is how much responsibility do you want your family to have? When you're in need of care, do you want your children to be your caregiver, or do you want your children to be your children?
I think also looking at the amount to insure. You don't always have to insure the full amount of what the long-term care cost would be. You see what you can self-insure and then insure the gap there between.
Yeah, I'm a big believer that no one should fund the entire amount through insurance. There's some amount of care that you can afford to self-pay. Now let's make sure we insure the difference so you don't impoverish a healthy spouse or you don't spend down all of your assets. You have something that goes on to your children.
Right. And so when they go through the planning, do you find that do most people like to involve their kids when they're doing their planning, or is it more that they're like, I want this in place for myself, knowing so my kids don't have to deal with any of it?
It's about 50-50, honestly, about 50%. And we would prefer the children be involved, but about 50% of people do want to involve their kids. They want to make sure that they have that conversation. I have this plan in place, not only, some type of maybe insurance plan, but I want these accounts used if I need long-term care. This is where I want to receive care, even as far as, I want to go to this assisted living facility over on this street here, if it need be. The other 50%, they're just not ready to have that conversation with their children yet. And we actually have a system in place that you can put down all of your wishes. It's not a legal document, but you can record all of your wishes, where you want to receive care, which accounts they should use. For maybe it's one of your children that has your durable power of attorney rights. And that's communicated to them only when you actually need care.
Right. So the durable power of attorney, that's a big thing too. Say you have 3 kids. One kid might be the more emotional one. One might be the more business heady one. One might be the organized one who's good with money. So in essence, you kind of want to put together your team with your kids and make each one of them in charge of a different sort of portion, right? Is that
there's the financial and the legal side of that interfamily relationship. Kids are different, and now to make it even a little bit tougher, they're not all in the same area anymore. They're spread all over the country. So you want sort of the more prudent one to maybe be there on the financial side. You also need a healthcare surrogate designation. So there's the person that can make the financial decisions and legal decisions for you, and then someone else, or maybe all three of them, that make the healthcare decisions. But you also need to communicate that on the care side, because I've seen a lot of families, children and siblings, that have been torn apart because the parents didn't have a plan, and the care burden doesn't fall equally among the children. You may have 3 children. One of them may be a girl, and we see it fall disproportionately on daughters. And then it also depends on who's local, who can provide care.
Right.
And if all of a sudden, there's one family member that's, mom's moved in with, and that they're having to cut back their job, like we said, it's $655,000 as soon as they move in. How unproportionate is that? Is the burden on that child? And the other children, even if that child isn't worried about it, the other children may just guilt themselves into an issue. So.
And that's where, living wills are a big portion of that too.
Living wills, healthcare surrogate designations. There was some individual that made a lot of press in the Tampa Bay area that if she had a living will, we never would have heard her name, but it turned into a 4 or 5 year court battle. And
that can be ugly too.
Oh, yeah.
That's when it runs into probate, right?
Mm-hmm.
Probate is like a really ugly word. Everybody always, you hear it's an ugly word, but I mean, is it as really ugly as, people make it out to be? Like, because whenever you hear like, oh, did you hear they went into probate?
It can be.
This is the problem with probate. It's so easy to avoid. I mean, you go down to the bank with your payable on death designations. You fill out a form. That account's not in probate. Have your beneficiary designations right. Other than real estate, you can avoid probate everything, without much legal work at all. The problem is when people pass away and they don't do any planning, and the entire estate ends up there in probate. And people say they may pass away without a will. I like to say, you have a will. It's just in our case, the state of Florida has drafted your will for you.
And that kind of leads into is reviewing all of your current policies and bank accounts and how are they titled and who's the beneficiary, and that may open up an opportunity of, if you have an existing life insurance policy, there's a possibility that you can use some of that cash value to fund long-term care if funding was one of the concerns. So there's a lot of different options that are available, just a matter of sitting down and having everything in one place.
Right. And one of the terms that I heard from an attorney when we were talking about probate, he said, well, here's the thing with probate. The only person that wins in that is me.
Right.
That's true.
Attorneys love probate.
Yeah,
that's for sure.
Yeah, he's like, I'm not going to lie to you. He's like, I make a lot of money off probate, but that's because people don't go through and plan.
And it's funny, you don't see the attorneys advertising to do reviews of current policies or changing, and that's could be a big reason why.
And even right as you're going through it, you would think that's when you would make a correction. We just had a client that came in. His wife just recently passed away, and there's about $7,000 sitting in a checking account that was in her name only, and he can't get to it until it goes through probate. And I'm sorry, she didn't put a payable on death designation. She could have easily filled out a form. And the next question I asked them was, have you done that on your accounts yet for your daughters? Well, no, I haven't.
You better get on it.
Yeah, get on it and do it right now. It's the same thing. People may be experiencing issues right now with their parents when it comes to long-term care. Look at all the work you're going through, all the turmoil you're going through with your parents. Don't you want to avoid that for your children?
And it's simple steps that I think a lot of people know they have to do it and are putting it off. And by actually sitting down and doing it, it's going to take far less time than the time that they're worrying and putting it off till the next day.
You're listening to Planning for Long-Term Care with Key Planning Partners. If you'd like to receive a free copy of Marie's book, Tax-Free Money for Long-Term Care, call 888-PLAN-LTC. That's 888-752-6582.
We're sitting here with Tom Visello and Marie Colbert from Key Planning Partners, and we're talking about planning when it comes to your future and long-term care.